Anyway, a MYGA is a multi-year guaranteed annuity. I will say it's like a CD alternative in the fact that you tell the insurance company, just like you would tell the bank, how much money you want to put in. Then you tell them the term. We have access. We are fully independent, so we can actually have access to multitudes of different companies and their rates. But we have these MYGAs that go anywhere from 1 year up to 20. So if you tell me you've got $100,000, but you do not want to tie it up, you just want to get through the elections, you want to get through MPOX, you want to see what happens a year from now, we can tie it up for 1 year. Our current rate, I think it's okay to say this, as long as you understand that today's date on the 22nd of August, 5.5%. If you, for example, did a 2-year or a 3-year or a 5-year, Anthony, tell me a little bit about 1099s every year. Tell me a little bit about the tax advantage to a MYGA versus a CD.
So, there's a difference between tax codes and the investments themselves. If you're in a Roth tax code, if you are in a traditional IRA or 401k, you're deferring your taxes. If your money isn't in one of these tax codes, it's what's called or referred to as non-qualified money. Think of non-qualified money as your checking, your savings, money you're spending with your debit card, your credit card, the money you're transacting day to day. So if your non-qualified money, like your money in the bank, which you probably didn't realize for the last 15 years because there was no interest rates, you actually get 1099 on your money every single year. Every interest payment that you get from the bank, you're supposed to pay taxes on. So
even though I'm not going to use
CD,
even though I'm leaving it.
Even though you're leaving it. So if you have a 5-year CD and you're not touching it, you're getting taxed every single year on those gains. So if you use non-qualified money, taxed every year. If you put a CD into an IRA, then you defer taxes. However, if you use a MYGA, which is, kind of like a CD alternative, and you use non-qualified money, your taxes get deferred. Annuities and life insurance are the only vehicles that I am aware of that will defer taxes until you actually take the money out of that vehicle for non-qualified. Otherwise, you're going to pay taxes as you go.
And I don't want to go down this road, but life insurance death benefit in the state of Arizona is actually tax-free. So you can turn pennies into dollars and leave those to your kids. Yep. That's why I said I'm not going to go down that road, but I want people to know there are huge tax advantages available to people that explore their options.
So not only with MYGAs do you get to defer your taxes, but in a lot of cases, obviously not all, but in a lot of cases, they pay higher interest rates. We've been tracking this for years. When I look at it today, right, and maybe there's other stuff out there, but again, as of August 22nd, when I look at bankrate.com and I look at what we have offers for our MYGAs, the 1 year is 5.5% MYGA, a CD is 5.1. The 2 year is 5%, the CD is 4.75. The 5 year is 5.65%, whereas the CD is 4.2. So, but let's make everything equal. Let's say that you've got bank money you want to invest in a CD and it's 5% in a MYGA or it's 5% in a CD. You're still going to come out more ahead with the MYGA because you're going to be able to defer those taxes.
So compounding growth.
Exactly. So,
and you know what I think you're going to hit, and I just want to rush the issue a little bit because I can't help myself. When you have a CD, for example, 5-year CD, if you go to FDIC.gov, you're going to find you have 1.17% guaranteed coverage through the insurance coffers at the government, the Federal Deposit Insurance Corporation. How much guarantee do you have on your money with a MYGA?
Insurance companies are forced to carry surplus. They're forced to have reserves. I would say a lot of the companies we represent have solvency ratings of between 104 and 108%. Some more, some less. But that's saying that they don't have just 1.17 reserve and actually really no savings at all because that's the FDIC, not the banks. The banks have fractional reserve banking, so they're really not saving much. But these insurance companies are forced to have reserves and reserves on top of their reserves.
And by the way, how ironic, how hypocritical. The federal government doesn't have to have reserves, but they force insurance companies that are controlled through each state, not federal. They cannot operate in a state if they don't have reserves. They have to have your money 100% guaranteed.